I'm Kate Henriksen, co-CIO at RLJ Lodging Trust, and I will let our esteemed panel of over 100 years combined experience introduce themselves.
Hey, good afternoon, everyone. I'm Anand Jobanputra. I co-lead the hospitality lending effort at Wells Fargo. So we have about $11 billion of lending to the lodging space all across the country. We lend to public REITs, opportunity funds, private owner-operators, spread all across the country. Our average deal size, probably on the larger end, is probably closer to $50 to $75 million. But we have a dedicated group that just does hospitality, which is a division within commercial real estate at Wells Fargo.
My name's Jim Petty. This is a different year than last year. Last year, our stock plummeted 93% the day before this panel, so I was in a great mood, almost not intoxicated or medicated, so that was good. So I'm Western Alliance. We have a hotel group that's grown. We've been together for about 17 years. We're up to about $4.2 billion. We originate term loans, construction loans, bridge loans. We do a little bit of everything. We have three people that cover the United States, myself, Barry Lieberman, and Chris Williams that are around the conference. If you are located in that area, they can help you. We're originating, we're open right now. We've closed a couple $100 million in Q1. We're slated for another $500 million in Q2. That's refinancings of existing deals, construction loans, and new acquisition loans. We're on a growth trajectory where we'd like to grow about $600 million this year. So with the runoff, we're going to have to close about $1.5 billion, as I was told last night at about 7 o'clock. So with that, I'll kick it over to Michael.
I am Michael Lipson. I'm the CEO of Access Point Financial. We are a hospitality-only lender, and lender. We don't do equity, but we do everything below equity, mezzanine, preferred, bridge, construction, CapEx lending. Portfolio is a little over $2 billion today. And we, like most people, we suffered last year in terms of volume. This year, I think by the end of the second quarter, we will have gone beyond what we did all of last year. So we'll target between $750 to $1 billion in production this year. Average loan size, by the way, around 17 million. So we tend to go more limited service, extended stay product, big fan of, and we try to stay away from the larger full service deals.
My name is David Turley, and I run Kronheim Hotel Capital. We're a national capital advisory firm, always known as a broker. And we act as an intermediary between owners, operators, developers, and capital sources. We closed just over $1 billion of hotel financings last year, kind of coast to coast, 34 transactions. That skewed a little bit larger than kind of a normal year on both the average transaction size and the volume-wise, a couple of larger transactions in the mix. But we do a lot of mid-market, limited select service financing all over the country using a wide variety of capital sources, local banks, regional banks, credit unions, debt funds, CMBS, and life insurance company financing. I should point out, of $1 billion we did last year, we did one CMBS loan. So the market has definitely shifted quite a bit since 18, 19, when there's a lot of that happening. And transaction types include construction, acquisition, refinance, bridge, repositioning capital.
Great, thank you. And we're going to start just asking you guys some questions. We're going to do a quick poll so we better understand who is in the audience. I guess who in the audience is currently in the market for hotel debt right now? Okay, you've come to the right place. And who is expected to or needs to refinance a hotel this year? A lot of the same people. Who thinks there will be in the market for an acquisition loan this year? Okay. And then how about any people looking to build? Who's in the market for a construction loan? good number of those as well. We got a good cross-section here. And then we'll do a little gambling here. Who's putting their money on the Fed increasing interest rates today? Okay, lowering interest rates. Okay, couple. And so vast majority of you think that they're gonna leave them steady. Okay, you voted.
I voted.
Why do you think they're gonna decrease them today?
Look, I would tell you, our view has changed. Wells Fargo actually thought there was going to be 150 basis points of rate decreases this year, and then we went to 125, and now we're at, we think, 100 basis points of decreases. Actually, you're running out of time. Like, when are you going to do it? So I think the consensus now, and we're actually on the aggressive side. The street would tell you it's probably 75 basis points of rate decrease this year. We're at 1%, but I don't think anything's going to happen in June. I think July is probably the first time we'll get a rate decrease, and it'll probably be 25 basis points. But we still think there's going to be 75 basis to 100 basis points of rate decreases this year.
Not until July, probably.
But not till July.
That's where you're putting your money.
Yeah.
Oh, my answer. Oh, sure.
Only if you want to.
Well, the bank has their view. My view is that the government's so screwed up, they're going to react late, and it's an election year, so that's going to really screw it up. So I have no idea.
What? And we're not betting on anything. So I, obviously in the hospitality industry, but I spent a lot of time in my history in the capital markets area, and I can tell you, you went from everybody at the beginning of the year looking for the 150, 4 to 6, rate cuts.
Now they're down to half.
Excuse me?
Now they're down to half.
And now they're down to half, and if I were a betting person, okay, I think that highly unlikely you get any this year.
That's what I was saying.
Yeah, I agree with you, is with the election coming, even though they're not supposed to be political and everything, that the Fed is not going to move rates. So in terms of planning, if I'm sitting in the audience and I'm planning, on refinancing, or if I'm planning on getting a construction loan, you've got to assume that you're not going to get a significant downturn in rates.
I'm a betting man, so we should bet after this panel ends,
Yeah.
if you want.
Oh, I'll cover the G's,
Yeah.
but I still don't think you're right.
I'm taking the other side. I think rates are going to come down this year. I think the question that maybe that seems consensus except for up here, but I think the real question is how fast and how far, and where are they ultimately going to bottom. I mean, the Fed's mandate is to control price stability, inflation, and employment. And right now, employment is doing just fine, and we're getting closer to a solid inflation picture. So if the Fed can get inflation down to 2.5% with a Fed funds rate at 4 versus 5.25, maybe that's good enough. I think a lot of people are expecting when rates go down to go back down similar to where they were, and I don't see it. So I think we're kind of in a higher interest rate environment for a period of time, and maybe forever.
One thing I forgot to say, feel free, we want questions as we go along and would like to make this conversational to the extent possible. So if you have any questions, there's a couple microphones. Feel free to go to one of the microphones or just shout out and we can repeat the question. But if I don't have to use any of these questions prepared here, that's perfectly fine. So just wanted to leave that open. But if there aren't any immediate questions, so how does that play out? If there were no interest rate decreases this year, even though that was the expectation, going into the year, what does that mean for lending? What does that mean for any lending targets you might have had in 2024?
I mean, I'll jump in just with a very broad perspective on kind of how banks in particular are kind of dealing with this very broadly. But high rates have pushed up, the cost of deposits, effectively banks' cost of funds, pretty dramatically. And anybody who did fixed rate lending is historically at low rates, is seeing their net interest margins get really squeezed. So you have profitability vanishing, while if you have a securities portfolio, which is how SVB got into big trouble, their mark to market, meaning if they had to sell other securities, they would take a huge loss because they bought at $1, now it's worth 75 cents, right? As bond yields and prices are inverse to each other. So you've got cost of capital issues, you've got potential losses in security portfolios, and both of those things can be affected significantly by rates kind of staying too high for too long. On the other side of our business, we're financing a shopping center right now that actually New York Community Bank has been in the news. They have the existing loan, and there's 5 years remaining on the loan, and there's a rate reset coming up in 2 months. The rate's going to go from 4% to 7%. At 7%, the loan does not cover. And in order to maintain the loan with New York Community Bank, the borrower's going to have to write a check for about $4 million. He's not going to write a check for $4 million. We're having to finance him away from the bank. But if you're a bank and you have a whole portfolio of assets that made a ton of sense as loans at 3.5% to 4% interest rates, but they don't at 7.5%, 8% in some cases, you're in some big trouble. And there's a lot of banks out there that are having a hard time getting loans paid off. So their book is just static. They're not getting payoffs, and they're just as a result, not doing a lot of new lending.
Yeah, when you don't have runoffs, right, it's hard for you to go do more loans. But typically, our book, just speaking specifically, we would have $2 billion of runoff every year, right? So people are paying off, refinancing in the CMBS market or selling the asset, and then we would go do $2 billion, $3 billion of new loans. And now, to David's point, we're not having that runoff, and so it is stagnant, right? You don't see a lot of volume. Banks have also changed their focus and shift to returns. Before, you could make enough return on a loan only and say, okay, we're getting enough spread, and the return makes sense on just the loan. And now that return doesn't hurdle for banks, and so they need other ancillary income, whether it's deposits or interest rate hedge or a CMBS deal or something like that. And so it's not a loan only for banks. So you guys as borrowers should think about, hey, how else can I help the bank so they can help me make the loan, right? And you can have a conversation and talk to them and say, can I give you some deposits? And historically, that was only in construction loans, but now it's actually on term loans, standing loans, and any other type loan that you might be doing, an acquisition loan, to help banks hit their return model.
Yeah, we must be a different type of bank because we're actually in a growth mode. So we're looking to grow the portfolio by, again, 12 to 15% this year. We are going to replace our runoff, so there will be additional dollars that we'll put out. We do enjoy deposit relationships, but quite frankly, if you don't want to do business with us on deposits, I'll still look at the deal. Probably won't do the deal, because if you don't want to do your deposit relationships with me, you want to park your money somewhere else, I'll park my money somewhere else. So if we want to just hit the truth button on that one. So we like to do business with people that do business with us. It's just a fundamental truth. So.
Yeah, I mean, I think I won't repeat everything that everybody said here, but I think that you're getting a general sense, at least my takeaway, is that the money is going to be a little harder to find. Okay, so that's good news for David's side of that over here we're building relationships. Even though we're private equity, we function with these relationships over here, and the expectation is that you will have a stronger relationship with the sponsor. Obviously, deposits, we don't take deposits, so our pricing is a little more expensive, but we're going around the country and doing business in all 50 states, 48 states, continental U.S. So I think you just got to be cognizant of, if the general consensus is that the rate cuts are not going to be significant, maybe there's one, maybe there's two, or there's maybe zero, is you got to plan for it. So what we're seeing for a lot of sponsors is start with construction loans. I designed the property, I planned it, I did all my analysis based on interest rates that were half of what they are today. So the numbers don't work. So now I got to go back and reassess. Do I stall the construction start, or do I just accept reality? Because the reality is interest rates are not going to go back to where they were 18, 24, whatever it was, 36 months ago. And I would argue a little with David's comment about, because I've been doing this a little longer than David is, from a historical perspective, interest rates aren't that high, guys. It's what happened was the money got free for a while there, okay? And so, yeah, don't plan, yeah, could it drop a little? Yeah, obviously at some point the Fed's going to bring it down. But don't expect rates to be significantly, or go back to where they were 2 or 3 years ago, wherever they were, when the money was fundamentally free. And by the way, construction costs aren't going to drop either. So everybody's dealing with, if you're dealing with your PIPs or you're dealing with new construction, we're seeing construction costs explode. It did explode. Guys, they're not going back down. No, that's called deflation. And you don't want that, okay? Because your ADRs will also deflate too. So, you got to make a decision. Do I bring in more capital into the deal? Do I abandon the deal and maybe sell off the plans or whatever? But we're seeing that. And the same thing on bridge loans, there's a ton of, in the CMBS world, ton of maturing loans coming in hotels. And that's great. And there's going to be a lot of classic, what we call pretend and extend. I think most of you are familiar with that term. There's only one little problem. Okay, if it's a two-sided conversation, me as the lender and you as the borrower, that's okay. We can figure out the pretend and extend, okay? But we all have a partner in this, and that's Marriott, Hilton, Choice, and they want something called a PIP done, okay? Because guess what? They let you get away for the last several years without doing any improvements to the property. And guess what? While the revenues are way up, guess what's dropped significantly? Guest satisfaction scores. I mean, I've seen some stats that are pretty unbelievable where this industry's got to deal with that. So there's going to be a need for a lot more capital to come into the industry. And so either the bank, you're going to have to develop a better relationship with your bank so Jim can extend it, or come to us, someone like us, to figure out that, lack of politically correct term, that menage a trois.
Yeah, well, it means something different in California, but as a point of reference, just to land Mike's point, back in 1980, my dad was building houses. I'm not saying you're old. But prime was at 18%. Jimmy Carter was a hell of a president. So, I know it feels bad when you're lending or borrowing money at 8%. Brother, it could get worse. So I think it's going to get better, but it's just a good point of reference.
I'll take 30 seconds if I can on a personal note. You bring up 1980. I started a new company in 1980 doing FHA lending, okay, multifamily. And back then, credit cards were capped at 18%. So your American Express card was capped at 18%. We were doing Ginnie Mae's, which is government guaranteed bonds, on multifamily deals at 21%, which meant...
That was not 2.1.
That's 1. So for you young kids in the audience, you all look younger than me.
That's high.
That's high. But guess what? Business got done. People figured out how to do it.
Well, they just
More
put it on
capital,
their
more equity.
Amex card.
You can borrow on your Amex and
Yeah,
go buy some
exactly.
government bonds.
But what I will say
I like
is
Visa for the points.
if rates ever get back to anything close to that, the banking system is toast. Because there's trillions of dollars of loans that are
I don't
way
see a
underwater.
scenario where it would go back to that.
No. But
We built a world, and listen, in the hospitality industry, there's cash flow, right? Fundamentals are good. Properties make money. There's cash flow to pay debts. We're not as interest rate sensitive as an asset class as other asset classes, other real estate asset classes are. But industrial storage, multifamily, not to mention office, but those three in particular are very, very interest rate sensitive. The margins are very small, and there's a lot of stuff that, got developed at 5.5, 6.5 yields on cost that, don't make sense, if interest rates are, going to park where they are and, cap rates are really 7. So, we do have the benefit of a little bit more margin, a little less interest rate sensitivity. Since I brought it up, the office asset class is actually is a factor in hospitality lending. It is Barry Sternlicht from Starwood recently came out and said office is a $3 trillion asset class that's worth about about $1.8 trillion. So it's like a $1.2 trillion of value destruction, capital destruction. And he's like, and he points out, he said, we don't know where all that is hidden, who's holding all those positions. Lenders do not want to do much in the way of office. They're concerned enough about their existing portfolios, not to mention, kind of lacking a view of where officing is going. That's ultimately good for hospitality lending because that's a big asset class that lenders have to find a substitute for. And hospitality is getting some of the benefit of that. We're seeing that not only in the kind of bank space, but in the big capital market space where, a touch of good news, the spreads are narrowing as the market becomes convinced, present company notwithstanding, the market becomes convinced that rates are going back down. And they're like, hey, let's grab some of these yields while we can before they go away. And so like CMBS bonds, CMBS did almost nothing last year because who wants 8%, 10-year fixed rates? But those guys are seeing a lot of demand for their bonds right now. Their spreads are coming in. CLO spreads, those are the way that bridge lenders finance themselves. Those spreads are coming in. And more acutely for hospitality because people want, access to the asset class.
It was amazing to me, a lot of the equity funds that got into private lending prior to COVID. Hotel lending was a 4-letter word because, you guys get your rate reset every night. You don't have good rent rolls like office buildings. So we were just a third child or a stepchild in the lending arena. And then after COVID hit, all of a sudden they're like, oh my God, you know how good you guys are? You get to reset your rate every night. Look at all this yield and we can still get some debt service. So, everything ebbs and flows. If you pencil your deal in between 10.5% and 11% debt yield, the interest rates will ebb and flow. You're probably fine. That's probably going to put you in the 55 to 60% leverage. If you can do that, build a couple hotels. You can't, well, go do storage units or so. I don't know. You're not going to sleep well at night if you're a hotel owner. So.
I think I saw a question. Yep, in the middle there.
Yeah, you referred to the banks and the margin pressure. And I haven't read a lot about the regulators coming in and requiring capital allocations. And I'm curious how that is mechanically working when a loan is coming due that your shopping center you mentioned. When it reprices, it's not going to cover the regulators in advance saying, well, that looks like that person doesn't write a check. We need to see some capital against it in the bank. And obviously that's sucking up liquidity if they're doing that. But how have the regulators been in this environment?
I can cover that. So there's new requirements called Basel III that's coming out, and so the FDIC, the Fed, like everyone has come together and they put these new requirements, which are capital requirements for banks. For every loan they make, they have to reserve X amount of capital. So that came out last year. There was a comment period in January of this year where all the banks, the GSIB banks, all kind of commented. The final ruling comes out in the second half of this year. But what's going to happen is banks are going to have to reserve extra capital for higher levered loans. So anything like over 60%, they're going to have to reserve more capital. For construction loans, you have to reserve more capital. So it's going to be harder to obtain debt, frankly, on the balance sheet, right? And so to David's point, we've seen a flurry of CMBS opportunities. I think Wells alone has like $5 billion of lodging CMBS coming in the pipeline in the first half of this year. And so everything is moving towards CMBS as opposed to balance sheet. And those rates are lower than you would, go get on the balance sheet today. I mean, just think about where balance sheet lenders price. They price off SOFR. So SOFR's at 530 today. If the pricing's at 370, just for easy math, right, that's 9% debt. And you can go do a CMBS deal, in the low sevens, right? And so it makes sense to go do CMBS as opposed to go and do a balance sheet deal. But to answer your regulator question, banks will have to reserve more capital in the future. That, all across the spectrum, larger banks, regional banks, they're all going to have to reserve more capital for loans, highly levered loans and construction loans.
Layman's term, your cost of capital, if you have to reserve more, it's more expensive. So it's going to be yet another pressure on the NIM.
It does matter, just to finish the comment, it does matter the size of the bank. Like one of the reasons that your community bank is in the news is it surpassed a $100 billion threshold. It gets regulated more strictly at that level.
Correct.
Which is part of the reasons that it's had issues. A lot of the smaller banks are much more immune to some of these bigger pressures, and they're regulated differently. So we're finding that the small $2 billion, $4 billion local bank or credit union is a great place to find capital right now because they don't have the same kind of regulatory pressures.
Interesting. Any question here?
In this environment, everyone needs to be creative in a way about building out a capital stack, et cetera. Are you seeing more and more banks or lenders consenting to CPACE out there? Is more getting creative and getting into the capital stack?
Yes, to a degree.
And I think you guys may have a group that doing CPACE.
We do. We do on the West Coast, and then we partner with somebody in Pride for some support that does CPACing on a non-regulated debt fund ability. If we do allow CPACE, and it gets a little complicated, if we were willing to do the deal at 60%, we might do it at 65% and let them go from like 55 to 65%. But we're not just going to add it on top of the stack. It's going to be embedded in our original debt stack. So you're not going to get a one-for-one on the CPACE. I think CPACE is a very good option, but it does get perfected lien over the debt or the senior debt, which banks don't like.
Yeah,
It's a no-no. So
CPACE is not equity.
it's tax. It's
It is
tax
debt.
benefit.
I can't tell you how many times we get approached by sponsors that say, well, I can get XYZ to give me a CPACE loan, so therefore, I've taken care of 50% of my capital stack, my equity stack. No. Okay, so.
You're mean.
Yeah, we're mean. If I'm a bank and I'm not going to speak to, I know what Jim does, and I know what other banks do, and I know what our bank relationships is. Most banks do not look kindly on CPACE. Okay, they may allow it, but they do not look kindly. So translate that any way you want. We do not look kindly on CPACE. Again, will we allow it? Yeah, possibly. But again, it's not a substitute for equity. And we go from a first position to effectively a second position. So you can take that and extend yourself out in the conversation. I don't have to tell you what that
I
is.
think CPACE is a good product.
Yeah.
It's just how you use it and when you use it.
No.
I think it would be better on a residential.
Yeah.
deal.
Put it on the house.
The thing to keep in mind for CPACE, though, is it's not, we're using it in a couple situations to shrink the seniors so that we can find a bank to do a loan that's otherwise too big for them. The problem with CPACE for construction, and you don't hear about this in any of the pitches, is it all funds up front.
Yes.
So you're paying interest from day one, but you may not need those monies for 18 months. So if you model it out and you carefully model out, like when do you actually pull the proceeds, and it depends on the state. In the worst case scenarios, you can only use it for the energy efficient stuff that happens more towards the end of the project. I mean, the effective cost of capital can be high teens. So it's really, it's billed as like, oh, it's like cheap equity. It's not equity. It's not even cheap debt. And there are some of the guys are trying to kind of come up with creative ways, or to shrink that net, the net interest margin kind of drag, but it's still very
I'm
small.
late for lunch. Sorry.
I think we're done. Is that what that means?
No, sorry.
Did I miss any hands for additional questions right now? Right there, please, in front row.
This is primarily for the bankers. My name is Kanamir Malaysia. I wanted to ask you for the deposit that you guys are looking for. Is there a percentage of the loan amount that you guys consider as a good rate, if you will?
Yeah, 100% of your loan, then you can self-fund it.
No, that's only on the West Coast. We're much better on the East Coast. No, I think as a rule of thumb, the kind of the 10% to 20% would be a nice number. We have several relationships that we have a lot of money with, that have, kind of in that 5 to 10% range, but we've also been doing business with them for 12 years. We have some other groups, based on the way they're set up, they have 25, 30% deposits with us. So it just really depends. I think it just comes down to the relationship.
And it's not the 10 basis points or 20 basis points they used to get on deposits. Now banks are actually giving returns on deposits, right? Like you can get 5%. You go put deposits in the bank, you can go get 5% from your banker on your deposits, give or take, right? And so it's not like you're just parking that money, it's just gonna sit there. You're gonna get a return on those deposits, so.
I'm glad you guys are doing this. So some of the smaller banks that I'm dealing with in Virginia, they want 50%, and they're like, no interest.
No, they don't want 50%. They're telling you to go away. They don't want you to do it.
They're quoting to
You
lose.
just didn't read the fine print.
Well, it all depends on, the banks.
They're very small.
Yeah,
Yeah.
so, yeah. But also remember, hotels are operating businesses. So hotels have
Yeah,
you
so
got
you put
credit
the
cards,
operating-
you
yeah,
got
there's other
everything.
things you can do.
Yeah, so those are all things that, depending if it's a local bank, you can move into a local bank, and they count. So it's not just buying a long-term CD. Okay, it's the operating accounts as much, which are very valuable to banks.
We are not that good. There has to be more questions.
Yeah.
I'll ask a question. So, both sides, what is the profile of a deal that you recently completed, as well as what is the profile of a deal that you recently passed on? We'll start here.
You start with me? Okay. I'll start with the one we passed on. And so it's a new client. It's hard to come in without an existing relationship and say, hey, we want to go do a deal with you. There's no depository relationship. There's no other relationship. And to come in to Wells at a time like this when banks aren't really lending, it's difficult, right? And so for us, we shy away from those, and so we've turned down deals. They've been okay deals because, again, we went back to the interest rate, or 9% interest rate, and the deal was a 14, 15 debt yield. It was because we didn't have a relationship. They weren't, cycle tested, proven. They were, just rich guys who wanted to buy a hotel that didn't work in our box, and so we passed on it. Deals that we've done, so we've quoted for existing relationship. We quote not an 11 debt yield. We're probably closer to 12 and 13 debt yield. And to your question about how to get creative, we'll quote a deal for high threes, but we'll also do a hedge for them. And so they, if you do a 5-year swap today, SOFR's at 5.30. The 5-year swap rate's at 4%. Okay, you can buy that rate down by 1.3%. So you went from 9% and you lowered it by 1.3%. So we'll do some creativity around that. And we've made loans like that. But we try to be in the top 25, top 50 MSAs, cycle-proven, existing sponsor we've kind of done business with, and we try to recycle some of our capital, right? And so we have some runoff, and we'll use that capital for existing guys.
And amount of proceeds?
$75 million.
Okay, so on the larger side.
Larger side, yeah.
So I was just trying to think about that really quickly. As my credit guy says, I never turn a deal down, but typically we don't look at deals for smaller markets. I wish my partner was here, but he's at a wedding in California. Not his, it's a relative. But we closed, our little group in the Southeast, we closed 5 deals in the first quarter. We're actually closing one today for an existing customer. We have 7 more in credit underwriting right now, so we'll do roughly 12 deals in the first 5 months in the Southeast. The primary focus is relationship. They're all deals with existing customers. One was with a new customer that had a partnership with one of my existing customers. So as I've been saying on this panel for the last 3 years, if you don't have a good relationship with your banker, you might want to do that. And for the guy that's going to come up and say, hello, my name is Bob, I'd like to be your friend in a relationship, you're 3 years late, but I would love to try to see what we can do for you in the future.
So, definition of relationships. You know, these guys to my left will always price a hell of a lot better than I can. We start with that premise, okay? So I'm going to be looking at relationships in a different way. You come to me, first deal, that's the beginning of a new relationship. We don't take deposits because we're not a bank. So again, our money is going to be more expensive. On the other side of it is we go everywhere in the 48 states. We go, you know, do we like to stay in the top 50 markets? Absolutely. But are we really looking at the top 200 markets? You know, some towns I can't even put on a map and know where they are. We've done a Holiday Inn Express, or we've done you know, some other extended stay product. So most recent deals, to give you an example, is we did an independent in Chicago. Nice little boutique hotel, you know, had a 9 debt yield. We think that with some improvements that are going into the property, it will get to a 12 where, you know, you theoretically want properties. Same time, and just pure circumstance, we did an independent in.
Where'd you price that, just for the group?
Excuse me?
Where'd you price that, just for the group?
For the group, we're in the mid 500 spreads.
And then what's
Yeah.
our interest reserve?
Interest reserve, if we, obviously, because you're short.
Right.
Yeah, it's got a carrying interest guarantee, but it's not a full recourse loan. So, you know, we did an independent in New Orleans, same time. You know, again, $13 million loan. We just closed a big deal we did 2 deals recently. We did a AC at the airport, so if anybody needs to stay at the airport here, please stay at the AC. That's our loan. That was priced, I think, under 500, but it was a full loan. It was a full 75% refinance. We're about to close 3 loans in Sarasota. You know, so we do everything. Again, our money's more expensive. We tend to go higher leverage. We tend to go a little on the guarantees because we're getting paid. At the same time, we're doing construction loans. You know, I've got, for some of you familiar, obviously, we've done a number of wood springs for clients. I can't tell you what markets they're in because I know what states they're in, but I'd have trouble maybe finding them on a map. We've done, if some of you are familiar with the more boutique, quote unquote, My Place. We've done a bunch of construction loans. We're big extended stay fans. So again, loan amounts $8 million, $14 million, that. And then we announced here, you know, we're back doing PIP loans. So again, not a lot of conversation here. I'm surprised, and from this group, but on PIPs. But I tell you, every time I'm in in Washington, talking to Marriott, Hilton, talking to others, you know, the big issue you guys are going to have to deal with on your existing hotels is if your guest satisfaction scores are dropping, you got to expect you're going to be doing a PIP pretty soon. So you're either you're calling your friends and neighbors and making sure you're raising that as equity, or how do you put that in place? Well, what kind of loan? So we've come up with a new product which for that. So we're all over it.
We don't really turn down deals, with the exception of just getting to making sure there's there's reasonable expectations. Kicking tires is everyone's just too busy for that right now. But in terms of stuff that I'll just kind of a couple things in process just to give you a sense for kind of what's out there and what we're working on. We're doing 5 construction loans right now. One is with a kind of local bank in New Jersey. We're clubbing up a couple of banks on 2 separate projects here in the Atlanta area that are larger deals. Kind of getting back to the use of CPACE. A lot of banks are just capping out at 20, 25 million bucks. They just cannot get kind of larger than that. So we're clubbing a couple of them up to do larger deals here. There's a deal in Tennessee that we're working on where there's an existing client had an existing very relational bank that wanted to do the entire project. Said, hey, sure, I'll do 80% loan to cost, 80% loan to cost, but I can only give you $22 million, which is nowhere close to 80% loan to cost. So we're bringing in mezz. They would not go for CPACE, but we're bringing in mezz just to kind of get them from the 22 up to 75% loan to cost what the client needed.
Charlie, where are you seeing the senior pricing and the mezz pricing on construction?
Great question. I mean, it's all over the map. The banks are prime +1, prime -0.5, somewhere in that range. Pricing is all over the map. Mezz is 15 to 18%. It's not cheap, but it can get your deal done if that's if it's not a huge slug of capital. And another deal we're working on, kind of a downtown in a Midwestern market, loan coming due, and a client trying to decide whether they are going to, kind of what the hold period is. They have an institutional capital partner, and it's a decent debt yield, like 11.5 debt yield in place, which is like the lender's cap rate. And they came to us and said, hey, we want to consider all options. Like we might hold it longer. We want to look at kind of permanent options. We also want to look at more shorter term options. Show us recourse options. Show us non-recourse options. And so we put 15 options on a menu. And I mean, there's good news. There's that many kind of potential kind of capital options for a deal like that. And ultimately found that the recourse loans were not really cheap enough to warrant signing on behalf of the institutional partner. So not going to go with the bank. The partner wants more flexibility versus less flexibility, so it's not going to be a insurance company or a CMBS perm, and we're going to do a 3-year bridge deal at like prime +0.5 on a floating rate basis, non-recourse. So again, for that deal profile, there's still a ton of options. It's not where people want interest rates to be, but it still gets the deal done.
I think we're getting close here, but if anybody has one final question, or I'll close out with one final question. So yesterday on one of the panels, Teague mentioned that he's starting to get interest of people doing bigger deals, that he has a group came to him that has to place $200 million of equity. Obviously, we haven't seen a lot of those lately, partially because of the debt markets. Do you think we're going to start seeing some of those?
Now you're super late for lunch. Yeah.
Sushi will hold. We're good.
Will we start seeing those at some point this year? Or is the big deal or the portfolio deal going to return, or are we going to just be in the...
Yeah, I mean, we're starting to see the portfolio deals from the large private equity firms, Blackstone, Starwood, of the worlds where they're looking to refinance transactions in the CMBS market specifically. But on the balance sheet side, when we have larger loans, we'll look to syndicate. To Turley's point, we'll put together a syndicate of different banks to get to $100 million, where we'll be the anchor commitment. Let's call it $50 million, and we'll find two participants to play in the $25 million range and fill out $100 million. But we are starting to see the larger transactions come through now.
Yeah, I think all the larger groups are, I'm looking for some of my friends with the bigger groups, but they have hotels that they want to sell. So if they can get more by selling one-offs, great, but if they can get a good price for a portfolio, they'll do that too. So I think, everything's got a price right now. It just depends on, what your options are.
Well, I'd like to thank everyone on the panel. I really appreciate it, and thank you for the audience for helping us with the panel success.
Thank you.